Welcome back to Online Trading Summit. In this upcoming video, we have Aakash K. Hindocha participating in a one-to-one interview with me as I quizzed him on his trading journey. Aakash is a full-time trader managing his proprietary trading firm, The Profitable Indian in Mumbai, and also serves as a partner cum market technician at AstuteFit. In this interview, Aakash shared in details why he prefers a visual price action trading strategy. We went on to talk about his intraday and swing trading strategy and the daily workflow he goes through to implement his execution. Enough said, let's head in and take a look at what Aakash has got to share with us. Hey Aakash, good day to you. How are you feeling today, man?
All perfect, Philip. How are you?
Great. We are so honored to have you on board this online trading summit to share with the summit participants as well as myself your trading experience and the vast knowledge that you have over the years of trading. But before we actually start today's interview with you, maybe I think it will be really interesting if you can share with me and the participants a bit about your background, because I saw from your profile that you actually started to know about trading from a very young age, and your family has been like in the financial markets for a long time as well. So maybe you can just share with us right from the very start, how were you actually exposed to trading itself and how it evolved for you thereafter?
See, basically, it started off at a very young age. Like my personal family, my parents are not into stock trading since an early age. They entered quite late. But my uncle is into the stock market since the past 25 years. So since I was like 13, 14-year-old, I used to track tickers on news channels, etc. Now that was say early 2007, 2008. That's where the whole financial market bubble thing had appeared globally. So at that age, I started tracking it, and it got into a fancy that even I want to go there. So I pursued my studies accordingly. I took a commerce background, which you have three streams in India. Yeah, so I pursued my commerce background, and then I went on ahead with the stock market studies itself. I did my postgraduate as well as in economics and in the stock market. Yeah.
I see. So, from my experience, when we were in colleges and even undergraduates, I personally realized that the school doesn't really teach much about things like trading and technical analysis. They teach a lot of things about fundamentals, value investing, as such. So, in your school, in your college, do you actually learn about all these trading techniques, strategies, and such, or do you actually learn it yourself?
What you just said, that we actually realize only after we complete our schooling. We don't realize that when we are entering schooling, that the actual real world trading is way too different than what they teach in school. Yeah. So when I completed my graduation, then I realized that you need to educate yourself more about trading and its perspective. So I went on with higher studies. In that, I was introduced to technical analysis. Before that, I just knew what is the stock market and trading happens, value investing happens based on technicals and fundamentals. I was introduced to technical analysis and charts in my postgraduate studies. So I completed that, and then I pursued along with that master's degree in economics as well, just to get to know the flow of it. Yeah, because I am not very comfortable with economics, I mean fundamentals, but I wanted to learn economics because you have to get the knack of it in the country and in the economy you are staying in, globally what is happening, as to fine tune your technicals more. That's what I believe. I am not sure many of us would have been agreeing with it or not agreeing with it, but if you can place your situation on your charts, your global situation or your economic situation of a company or of the whole country itself, I think that's an edge.
I see. And at what age do you actually started trading real money, and how was the experience like?
I started trading real money with a very small capital at the age of 18. I was like glued to stock markets and like observing it since the age of 14. But the real big money came only after I was 23, 24. So the first initial 4, 5 years, it was a very small capital.
I see. And how was the experience like during that 4 5 years? Do you were you like profitable right from the start, or were there some very bad mistakes that you made during that learning phase as you become a proficient and profitable trader?
I was not at all profitable in the early ages. Okay. So generally, I had borrowed some capital from my father, and then I used to repeatedly reinvest my pocket money, and I used to lose because we have been on the learning curve from the same learning curve where every retail investor starts with. We all try to bottom fish stocks. We try to pick up stocks which are falling in our early days, okay, and not what when stocks are rising. We all try to do options because we think that, okay, in a small bit of money I can make a lot of money, but ideally options are hedging tools. According to me, in my today's life as well, I do not trade options. I trade only stock cash and stock futures. I do not trade options. Early age, the major mistake or major chunk of money I lost was in option trading. Okay, as well as trying to buy stocks below 100 rupees, like in India, like $2 for the global economy, trying to buy stocks which are below $2, trying to buy stocks which are consistently falling, trying to buy stocks which are near 52-week low instead of buying stocks which are at 52-week high. Now, there's a reason. What I have learned through my journey right now is that in a lot of retail investors make this mistake of buying 52-week lows instead of buying 52-week highs. Now, we need to understand that if a stock is at 52-week low, and if we trust the price, technical analysis and making money in the market is all about trusting the price, trusting the market, rather than trying to develop a gut feeling of your own self that, okay, I think this may be right. No, if the market thinks that is right, go with the flow. Yeah. So if the market is telling you that a stock is at 52-week low, there is a reason behind it. Let's just try to obey that reason and not buy a falling knife rather than buying it. Another mistake what I used to do when I started derivative trading initially was that, see, in India you are not allowed to short cash stocks. Out of the 5,000 listed stocks we have on NSE and BSE combined, we are allowed to trade only on 210 stocks which are in the derivative segment to go short, whether will it be via options or it will be via futures. So what early mistakes I used to do, another was that because it has increased too much, let's go and short it. It cannot increase too much. Now that's the lesson. Now that's the lesson you learn hard way. Yeah, that it has increased too much because there is something behind it. Maybe there is an expectation of some news by market participants. Maybe the earnings are going to be good. That is why people are betting in favor of it, right? So you should not bet against it. So there comes a quote that you should not buy falling knives and you should not stop roaring skies. If a stock is roaring at 52-week high or at multi-year high or probably at lifetime high, you should not go and try to stop that roar that, okay, I think it may not go ahead more than this. You should go and short stocks only which are falling in expectation that it will fall more, and buy stocks which are already rising in expectation that it may go and rise more.
I see. And how long were you actually trapped in this phase of destruction? So do you like lose your entire capital, and how long do you take before you realize that you were doing all this wrongly?
I lost my entire capital probably like 3 times, but those were small capital. Like it does not make any difference to your early lifestyle because I was trading along with my college. So you can imagine, like, the trading sum used to be 10-20,000, nothing more than that. 10-20,000 in India is like, in for global economy, is nothing. It's like, say, $400 or something, $300-400. So that used to be the capital, and I am very grateful that I lost, because losing the money back then was way more of a thing which is helping us right now. Okay, losing all the money I have right now, I may not be able to afford it. But losing all the money back then, that was a good thing that happened, basically.
I see.
And
And
I realized it probably after 3 years of starting into it. So after I completed my college, I started working as well as I started pursuing my post graduation simultaneously. So back then I realized that, okay, there are not one, two or four things. There are like tens of things which I'm doing wrong. Yeah, which I think a lot of retail investors, 80% of retail investors would have gone through it. They're trying to bottom fish stocks, which then they are stuck into for years together. And it takes like multiple years for it to revive and at least come back to their cost. Because one thing what people don't realize is that if a stock at $1,000 falls to $50, okay, falls 95%, falls to $50, it has to now jump 20 times for it to just get back to its original price. Forget the profit. People are trying to average it on the lower side. Rather, a best strategy would be to average it on the higher side. Because if you try to average it on the lower side, you buy more when the stock is falling, you are not accepting that you're wrong. You are not accepting your defeat. But if you average it on the higher side, you bought it at 1,000, you bought it at 1,200, 1,500, 1,800, then you are adding fuel to your winning streak.
I see.
That's
I
what
see. So
yeah.
that's actually, you're already sharing some best practices of trading already from that experience itself. So when did that aha moment came for you that you realized that you have been doing everything wrong and that you decide to make a change to all these things? Was there somebody who inspired you to change the way you look at trading, or was it some kind of books or whatever that resulted in you having that moment of change into doing something right rather than what you have been doing previously for the past few years?
When I lost my capital for the third consecutive time without making money. So it was not that all trades I was losing. If I am trading few bucks in one trade, I'm making another few bucks in another trade. The third trade, it takes all of those money, which you have made in one or two trade. A very important aspect in that comes to discipline. The trading discipline, right after being 6 years into practicing full-time trading and observing stock market since the past 12, 13 years, my conclusion right now is that charting, indicators, patterns, price behavior, everything is below 50% of what is required. Above 50% of what is required is psychology, execution, and discipline. So I realized it when I got busted for the third time in a row that there is something wrong. So I spoke to my uncle that this is what I am facing out. So he was like, it's very early for you to start. I would advise you to get yourself trained into what field you want to. Now, fundamentals and technicals are two streams in the market where you try to make money. I always wanted to get into trading rather than investing. Now, a person cannot trade based on fundamentals, right? Unless you are very well connected in India and you have all the news flows possible flowing to your inboxes every day or every hour to trade. Now, that's also an illegal practice.
I see. And so after you realized that there was something wrong with your trading strategies or the way you trade, and you started to improve by understanding what is the right thing to do. So thereafter, what kind of strategy do you actually start with when you started to become more proficient? And how is that different from the kind of strategies that you have right now that you are very experienced? Can you share with us the difference between the early days and right now, the strategy, the kind of differences?
The biggest difference from my early days and right now is that my chart appears more cleaner now, right? The more bombarded your chart is, the lesser it will speak to you. Like technicians believe that if you spend more time with charts, one day it will start talking to you. Yeah, and then every day it will start talking to you. So I jokingly tell people around that spend more time with charts than your girlfriends and wives, and they'll start talking to you, and they'll talk more sense instead. Yeah.
All right, that's interesting. So during your learning phase, was there any specific trading expert guru or legendary trader or any books that inspired you to learn what you have learned today?
See, I have read few books like Life and Times of Jesse Livermore, Basics of Stock Markets of Thomson Mayers, and Edwards and Maggie, etc. But those were in the learning phase. Rest, I think books cannot teach you the implementation or application of knowledge. Books can give you knowledge. You can be a very knowledgeable person. But in market, what succeeds is that how good are you in applying that knowledge? So I was introduced by a person called Sanjay Ved, okay, to technical analysis in India. Is a Bombay-based trader. He trades forexes. He is into crosses. Then it's a three-part journey. Like I was introduced to trading, to technical analysis from him. I was helped in refining my trades by another person, and the trading execution which has happened, which is handholden to me by my uncle itself. Like at the end, family is what helps you take you on board. Yeah.
Okay, so let's go into some discussion about how you actually run your trading business right now. So maybe for a start, would you like to describe to us what is the main trading strategies that you are most commonly using right now? Is it just one specific strategy, or you have a range of different strategies for different kind of conditions? Maybe you can share with us a bit more.
Yeah. See, I operate basically on three kinds of strategies. Okay. One is an intraday trading strategy where I am very strict that I do not trade stocks. I trade only indexes on an intraday basis. Second is a positional trading strategy, which is only on stocks. Never do I have a positional trade on any index. And third is trading cash stocks and trading long-term futures. Like you carry your derivative position, your leverage positions for like 6 months, 1 year, 1.5 year. In expectation, there's a theory behind it, and an expectation that the stock will rise, say 50, 70, 80%. Now, a 50, 70, 80%, even if it takes 2 years to rise, you are on a derivative trade, which you are already on 8x leverage. So that's a whole lot of money. But you don't bet a lot of amount there because the downside is also true. So you go ahead in those trades only if your risk reward is more than 1:10. Say for example, you are betting for a 1 year upside on a stock for 50%. Your stop loss should not be more than 5%. Yeah.
I see.
The first strategy on an intraday basis is that I trade Nifty and Bank Nifty. These are the most two widely traded indexes in India that I trade on an intraday basis. Now this intraday does not include time frame that I will start at the start of the day and exit at the end of the day. No, I can enter in the first 15 minutes and get out. I can enter say after 2-3 hours or in the last hour. That depends on what kind of setup, what kind of chart setup you get.
I see. So, okay, let's just focus a bit more on that intraday first. And then after that, we go on to the position one. For the very long-term one, I think maybe we'll just skip it for this time round, because I think most of the participants will be more interested in the either intraday or shorter-term kind of swing trading. All right. So for your intraday trades, as you said, you focus on just the indices and just basically two types, right? Nifty and Bank Nifty, right?
And bank.
Yes.
Yeah.
So, what exactly do you look out for as a trading signal when you are looking at intraday trades like such?
See, first I want to clear one thing, that I am only price action trader, so I do not use any indicators. So signal, looking out for a signal is not a part of the game. Yeah. So I do not look for any indicators which will give me a buy or sell signal. I have a personal theory behind it. I'll explain you after we are done with this. So basically, if you know patterns, like there are cup and handle patterns, there are inverted head and shoulder patterns, there are few continuation and few reversal patterns, say triangle breakouts, say rectangle breakouts. Yeah. So those patterns, I try to apply it on a shorter time frame.
I see. And what is the kind of time frame you look at in terms of, if you're using candlestick, are you using like a mini candle or tick, or based on ticks and stuff like that?
I use a 5-minute as well as a 15-minute candle combination. Okay, that's not on one chart. Like I have multiple charts open. Firstly, the breakout should happen on a hourly candle on a 60-minute chart, and then you try to place your entry on a 5 or a 15-minute candle in conjunction. So if you come to my trading screen on any given trading day, you will see there will be like Nifty spot candles of 5 minute and 1 hour. Okay, then there will be Nifty futures candle on 5 minute, 15 minute, 1 hour, and there will be simultaneous 5, 6 of charts open for Bank Nifty. So there will be like 12, 13 charts open in all to trade those two indexes. Now, if a pattern is giving you a breakout on Nifty spot, there may be a chance that the similar pattern is not giving you a breakout on Nifty futures. Now, retailers need to understand that Nifty trading happens only on futures in India. You cannot trade Nifty spot. Nifty spot is a derivation of those 50 components and it's just a price movement. So there's a compulsion that the same pattern should break out of Nifty futures pattern as well. Generally, when you trade stocks, you are advised to not look at futures chart. But if you are trading indexes, you are supposed to look at futures chart if you are trading intraday, because the spot Nifty may give you a false breakout. But the futures Nifty will not give you a false breakout because people position themselves only on the futures thing. People are betting on the futures thing, not on Nifty. If you are a Nifty trader, you have to compulsory buy Nifty futures or Nifty options.
I see. So are you, most of the time for these intraday trades, are you actually using a lot of a gut instinct to get in and get out in a way, or do you have very strict rules or formulation that you will only see this, then you will get it?
Yeah, I never trade on gut feeling because I think your gut can ditch you, but the price won't. Yeah, so I trade only if the price breaks out or breakdowns of a certain pattern. Like that pattern can be anything. That can be a triangle, that can be a flag, that can be head and shoulders, that can be cup and handle, anything. Anything which is derived out of price. The pattern could be anything. Unless it doesn't break out on both Nifty spot as well as Nifty futures, I don't enter the trade.
I see.
Yeah.
And so you trade, you enter on the breakout. Do you attempt to like enter on the pullback and reversal during the swing itself?
Yeah, I try to attempt on a pullback and reversal as well, but there are only a certain patterns which I try to do so. Like there is a rectangle pattern, okay, where the stock breaks out of a consolidation, okay, or the index breaks out of a consolidation. Now that consolidation on an intraday time frame can also be a 2 hour consolidation or a 90-minute consolidation, anything it can be. So that pattern is more familiar of retesting its breakout and then pulling back again. So I would look for a pullback only on that pattern. I'll not look for a pullback on all the patterns possible, because I generally trade Nifty futures not more than with not more than a 10-point stop loss when you are trading intraday, because you don't intend to make 50, 80, 100 points every day on intraday trades. You intend to make only 30 points on an intraday trade, because the average volatility from the swing high to swing low on Nifty in India on a daily basis is roughly 70, 80 points. And if you try to make 70, 80 points daily, that's just not possible.
So on the topic of a stop loss, how do you actually determine where the stop loss is? Is it based on a certain number of pips of pullback, or is it based on some technical levels? How do you actually establish your stop loss? And at the same time, how do you actually decide when to actually take profit?
The profit is taken based on what pattern. Every pattern has its own target. The target is generally the depth of the pattern, which you add it on the breakout point. That's a general scenario when you are trading price patterns. So I make sure that I take out 80% of my position on the target get hits. Then I say, for example, if I have 8 lots of Nifty, I'll take out 6 lots of Nifty on the target hit. I'll wait for how the index is behaving at the target point. It is coming back. Is it coming back, or is it giving a further extended move on the upside, to decide my rest 20-25% of the balance position for it to get exited. But I'm very much happy taking 20, 25, 30 points on a daily basis on Nifty intraday, because if you add this up, it will give you a staggering 30-35% monthly return. Because you do not require capital. People don't understand that you do not require capital to be deployed if you're trading intraday. You just have to place that capital with your broker. Also, you can pledge your shares to get the derivative trading margin if you're trading intraday. you have to pay him only if you make loss. You don't have to pay him if you don't make loss. Okay, so minimizing your loss is one thing that everyone should focus on. Now, coming back to your first question, that where do you apply your stop loss? Now, there are two ways where people apply their stop losses on. One is the swing low, where people apply their stop loss. What I have come to an observation is that if you use your swing low, then the odds of you entering trades with, say, 1 is to 10 or 1 is to 20 or 1 is to 40 kind of a risk reward ratio, which may sound right now that this guy is telling anything, but we do actually trade it. I have records of trading on such risk rewards. I have records on social media telling people to trade on 1 is to 50 risk reward ratio. That was just like 2 months back. Yeah. So if you keep your swing low as your stop loss, never are you able to get those risk reward ratios.
So typically for your intraday trade, what kind of risk to reward ratio are you typically looking at? Of course, not all the time they will be the same, but generally what is the kind of risk to reward ratio before you think that it's worth taking a trade on?
Minimum 1 is to 3.
Minimum
Nothing
is 1
less.
to 3.
Yeah, nothing less than 1 is to 3, because I believe 1 is to 2, anyone can do it. And if you're betting 1 is to 1, then try casino. Why come to the market if you're trying to bet on 1 is to 1? Yeah. So 1 is to 3 is the minimum risk reward ratio we try to look into a trade before entering. If we don't get on any given day, it's fine. We don't take the trade. There's no compulsion, or no one is holding a gun on my head that you have to trade today. It's fine if we don't trade on a given day.
I see. And for this kind of intraday trading strategy, it seems to me that you have to spend a lot of time in front of the screen, right? Because it seems to me that you are not like a systematic kind of a trading or algorithm trading, but it's really visually looking at it. So does that mean that you will have to spend a lot of time sitting in front of the screen in order to be able to see what any trading ideas to get in and when you should actually get out and stuff like that? Or do you have a systematic way of doing this entire thing?
No. I spend the whole time the market is on in India on the screen, from 9 a.m. in the morning to 3:30 in the evening. I spend the whole time on the screen itself.
Okay, if that's the case, do you actually recommend or suggest that like independent retail traders to actually try to trade intraday if let's say they have a job or they have a business to run? What's your perspective on this?
No, not at all. Not at all. If you have a job or a business, intraday is the last thing you would ever think of. Try doing a swing trading or try doing a positional trading, which will make you enter into a trade for multiple days to multiple weeks at least. Intraday is a thing where if you are on the screen, if you are a full-time trader, only then you should do. Also, it's the last thing a trader or an aspiring trader should think about doing. The major mistake which everyone comes across is that they do intraday trading as the first thing after they learn technical analysis. The first thing is what they try to do intraday trading, that okay, it's a risk-free trading. No, my friend, it's not a risk-free trading. Instead, the odds of losing money in intraday are higher than what you will lose on a positional trade. Because I think a lot of people talk about strike ratio. So I think the strike ratio on intraday trade is lower than your strike ratio on a positional trade. If your strike ratio on a positional trade say comes to 70-80%, the lower the time frame you go on, the lower will be your strike ratio. If you go on to an hourly chart, maybe it will reduce to 50%. If you go on to a 5-minute, 15-minute chart, maybe it will reduce to a 40%. But even at a 40 and 50% strike ratio, you will be able to make a lot of money, because if you have to be very strict with your stop losses, that if your stop loss has got hit, you have to exit the position. Second thing, you need not bet on anything which is less than 1 is to 3. That will help you stay afloat in any market scenario.
I see. So basically, if I can just summarize the aspect about intraday trading is that yes, it could potentially generate you very significant returns on a month-to-month basis. And the drawdown on a month-to-month basis can be actually quite minimal. In fact, it's possible to have positive months most part of the year, right? But of course, the downside is that for intraday trading, you need to have a full-time effort on it. You need to spend your time right in front of the screen, and you need to act very fast a lot of time. So there's always pros and cons to this kind of intraday strategy, right? So which means leading us to the next topic, which is your position trades itself. So I reckon that would be something that's more suitable for those part-time retail traders, right? So maybe drifting on into that position trading wise, what's the kind of trading horizon for you when you look at position trading? Typically, how long do you hold a certain position for?
See, a positional trading can be anything between 2-3 days to 2-3 weeks. That's what an ideal positional trading is for us when you're trading derivatives. If you're trading only the cash market, which a lot of retail investors are into, you can look out for from a few weeks to a few months, because the target ratio or the upside or the downside on a stock is also quite high when you are trading positional. You will not look out for 10, 20, 30 points on Nifty, but you will look out for few percentage points on a stock. For us, we do not enter a stock for, say, if I intend to hold a stock for more than 1 month. So we will not enter if the upside is less than 7-8%.
I see.
But
And
yeah.
and what kind of strategy do you use for your position trading? Is it still the same thing using breakouts as well in your position trading? And what are the kind of instruments or the asset classes you look at for your position trading strategy?
Currently, we are only into stocks. We do not trade index as a positional trading thing. The problem is that you are very accustomed to gap ups and gap downs as far as Indian markets are considered, because we do not have an overnight futures market. It is there where you are based at SGX. So we look at SGX Nifty, but being a citizen of India, we are not allowed or authorized to trade on that. So a lot of times what happens is the futures on Singapore exchange are indicating something which leads to a gap up or gap down. Yeah. So that gap up or gap down, if that gap up or gap down happens against me, then my stop losses have gone. Say for example, if I was a positional trader on Nifty and I am looking out for a 200 point move on Nifty with say 30-40 point stop loss. Okay. What if next day it gaps down 50 points? I compulsory have to square off my position. And what if the gap gets filled in the first 5 minutes? What do you do? What if the gap extends in the first 5 minutes? What do you do? After a 50 point gap down, it goes down to 80. And you are assuming that, okay, it will come down from 50, it will come down to 0. Or if you square off at 50 and it comes back to 0. That is why we have stopped trading indexes on a positional basis. For stocks, we trade out of the 220 FNO, 210 to 20 FNO stocks. We trade only a select 50 stocks, which are very strong. Like a strong stock need not be analyzed only on a fundamental basis. A strong stock can be analyzed looking at the chart structure as well. That it's not very volatile, it's very stable. It's a slow mover regardless, doesn't matter. But it has to be a strong stock. Okay, it has to be some of the sector leader, not a very low market cap, not a very small cap or mid cap company. Now, a benefit here happens that even if the index gaps down by 50-70 points, and even if the other sectoral index are in red, a strong stock will not fall. That's what our experience has been. A strong stock will not fall as much as the index is. That is why it's a strong stock. That is why we get into that even at 50, 70, 80 points Nifty down, if you are betting on a strong stock and other stocks are 2, 3, 4% down, your stock will be only 1.5% down, which will be well within your comfort zone or your stop loss. That is why we trade only on stocks on a positional basis and do not trade indexes on a positional basis.
I see. So you have a list of, you will say 200 over stocks, right? So does that list of stocks change over time? And when do you decide that you need to reshuffle the list of stocks that's inside your short list?
See, there are 220 stocks by the exchange in the futures segment. We have a list of only 50 to 60 stocks. Now, this keeps on shuffling, not very frequently, say maybe in 6 months, 8 months, if some company has done pathetically bad or it's giving continuous false breakouts. See, you have to understand that nothing is 100% in this market. Market is probability. Market is a place where you bet on probability, you bet on the odds of you getting right than on the odds that minimizes your losses. Yeah. So in such cases, what happens is, yeah, I lost it. Could you cut this?
Yes, I can still hear you, see you.
Yeah. I lost the link. I lost the link. Can you cut this part?
Okay, so how do you actually determine when the short list of stocks is going to change? Or you said it on a
Yeah.
half a year basis, right?
Yeah. Like we change it on a half a year basis based on, say for example, a company is trading at $1,000 and consistently is being performing poor on the exchange, regardless of what the news flow is. Maybe some negative news flow is influencing it, maybe some poor results are influencing it, maybe some raw material prices, maybe any fundamental reason is influencing it, and it is not performing well and it has become very volatile. Even if it is falling down, we can go and short it. Even if it is falling rising up, we can go and buy it. But if it is very volatile, say a weekly movement of more than 10-20% is being observed week on week basis, then we try to not trade it because it doesn't suit our temperament. I am personally not very comfortable trading very volatile stocks. Now there are two traders, two kind of traders. One is a volume based trader, one is a volatility based trader. I would want to classify myself as a volume based trader rather than a volatility based trader. I do not like very volatile stocks to be traded. Some people find it very exciting that, okay, if you are a trader, you need to trade on volatile stocks. We are somehow not very comfortable trading on very volatile stocks.
I see. And what's the typical strategy you use for your position trading? Is it same like breakout or pullback or what?
It's same on the breakout and pullback part. The only difference on a positional basis is that we use daily chart as well as an hourly chart. We use a daily chart breakout first. If the breakout has happened on a daily chart on any given pattern, what we discussed earlier, we try to find out an entry on a 60-minute chart.
Mm.
Why on a 60-minute chart? Because if a stock has broken out on a daily chart, say if the daily candle is 5%, then my stop loss is way much higher. But if that daily breakout is giving me a follow-up move, say after 1 or 2 days, say after 3 days, and I am trading on a fresh breakout on a 60-minute chart, then my stop losses is less and
Mm.
my target is still what the daily chart had indicated it to be. So to minimize my stop loss, I use a combination of 60-minute chart to enter early into the trade. Nothing else. The basic strategy is to trade on a daily breakout chart only.
I see. I see. And so does that mean that your stop loss and your profit taking strategy is pretty much the same as how you do it intraday, or do you implement things like trailing stop as such for your
See,
position
trailing
trades?
stop, because I am a price action trader. So trailing stop losses for me, there are no indicators or there are no moving averages that I will keep trailing my stop losses below it. Okay. So I trail my stop loss based on a fresh pattern,
Mm.
which means that, say for example, I'll give you example with numbers. Okay. Say for example, a stock is broken out at 500 rupees. Okay. I am trading it with a stop loss at 480 and a target at 600. Okay. Now, what are the odds that the stock would go from 500 to 600 this way? The odds are like 1 is to 100. Maybe one stock out of 100 will go in a straight way from 500 to 600, right? So currently my stop loss is still at 480. Now, assuming that the stock is a normal stock and say the 20% move will take it 2, 3, 4 months for it to get achieved. So the stock is not going to rise up every day 5% and hit its 600 mark. That's what the original theory is. Out like 1 or 2 exceptions are always welcome out of the 100 stocks you are scanning through. But then if the stock goes from 500 to 530, 540, 550, it has to consolidate after a run up, right? So when it consolidates and again starts running towards the target, we trail our stop loss at the consolidation point.
I
Because
see.
I don't have indicators, I don't have moving averages to guide me, because I think those are misleading indicators. That's my personal belief, nothing against someone who uses it. Yeah.
I
So
see.
I'll trail my stop loss where the stock had consolidated, where another change of hands between bulls and bears had happened. where another indecision for a few days had happened, and still bulls won. If it's on a higher side breakout, bulls won. So I'll place on the again on the last bear possible of the consolidation.
I
So I'll
see.
trail my stop loss there.
Okay, and with that, with regards to let's say whether it's intraday or position trading, let's say you decide to get into this particular trade already, how do you go about sizing your trades for both your intraday trades and your position trading? Is there based on some certain percentage that you are willing to lose in each individual trade, or some other ways? How do you size your trades then?
Yeah. See, in positional trading, which is from 3 weeks to 3 days to 3 weeks, okay, I do not enter a trade with a view that it will, I will get out of that stock on an intraday trade. For me, stock trading and futures trading is different. Also, I trade into different accounts. Okay, I do my stock trading into a different account, and I do my index futures trading into a different account. So while trading index futures, I go with only one strategy. That, say for example, we'll take for example 5 lots. So I'll enter with a 5 lot Nifty and with the view that I will get out at the target. In case it is retesting my breakout, I will wait for it to retest my breakout, and if it starts rising again from my breakout point, I will add on to my position, because this gives me double confirmation, even more confirmation than what I had entered my trade on, that okay, it retested its breakout point. Bears tried to bring it down, but they are unable to bring it down, and now it is again trying to go back to its target. So the odds are now more or less for it to go and hit its stop loss or trigger my stop loss. So I'll add on to the exact amount of position another 5 lots and exit everything on the target. Now this time I will not wait of my 80% of the position at the target. I'll not exit my 80% of the position. I'll exit my 100% of the position, because I have to understand that I am over leveraged right now. My ideal strategy is to trade only five lots. I am now trading 10 lots, then I am over leveraged. Now these are examples. I'm not telling that I trade 5 or 10 or 15. These are on a hypothetical example basis.
So how do you decide, let's say for this trade you want to get in, how do you decide whether it's going to be 5 lots, 4 lots, or 1 lot? Is there a particular way you go about sizing it? Or
Yeah, I started it with 1 lot few years back. See, now Nifty intraday trading, it's been 4 years now that I'm trading Nifty intraday. So I started with 1 lot. Now I would not want to disclose my position what we are trading right now, but I started with 1 lot. After consistently making profit for 2 months, I increased it to 2. Then I increased it to 3. Then I increased it to 4. So you now, on a consistent basis, if there is a drawdown on 1 month, you do not increase your position. You have to be consistently profitable before increasing your bet size. Because what happens if you make money for 2 weeks and then suddenly from 2 lots you go to 20 lots, that 2 weeks money is going to go down in one stop loss, 1 day stop loss. So
yeah,
that's what you have to understand, that you have to be very, very consistent in your profitability before leveling up. So that the odds of you coming down, see, there's always a downside open. Even for the best of best traders, there's a downside open, but you are minimizing your loss to come down again. You are minimizing your odds to come down again if you are leveling up very smoothly.
I see. Is that the same way you size your trades for your position trading as well?
No. Positional trading, I do not add on to my position. If it's a 3 day to 3 week style, I add on to my position for long-term positional trades. Because here, the problem here is that it's very volatile when it comes to stocks. Though we try to minimize volatile stocks, we try to filter out that, okay, we are not trading here. But still in India, the stock volatility is way more higher than what in the developed markets are. So we trade on a fixed position. Say if it's 1 lot, it's 2 lot, it's 3 lot, whatever it is, we trade on a fixed position. We do not add on to our positions. Yeah, but we exit in parts. We do not add on, but we exit in parts. We generally have 2 targets for each pattern. Generally, the general scenario is 2 targets on each pattern. We'll exit 50% on the first target, 50% on the another target. Now also you have to base a lot on price action, which means, say for example, the stock has hit your first target and it is on the way to your second target and does not hit. because there's no guarantee, right? There's no assurance of 100% your stock will get hit to a target. Say if, for example, if it does not get hit to that target, what will happen if it will give you a reversal sign? You have to trail your stop loss at least bare minimum to your first target, so that you take at least your first target money home and not lose out on that, because you still have your half position balance open. So you have to trail your stop loss at least where you booked your first profit. That okay, I've booked my first profit around that area, my revised stop loss is there. I will not allow my balance position to go down below this. If it goes down below this, I will exit it, so that you will at least go home with something, rather than, say for example, the previous example what we were talking about, 500 worth stock, a target of 600, stop loss of 480. Say for example, you exited partial position at 540 and the stock reverses from 570. You have to exit your balance position near about 540, say 535. Still you are taking home that 35 rupees in case the trade doesn't work out. You will obviously want it to work out, but then there are certain market circumstances where for a day, for 2 days, it comes down. Though it will not go back to 480, but it comes down a bit, hit your trailing stop loss and go again up. The odds are there, always there. Nothing is 100% in the market.
I see. Very interesting. And well, it seems like there's so much to do, especially for your case where you are trading both intraday position trading and even a much significant longer time frame, right? So how do you actually handle your day on a day-to-day basis? Maybe I think it will be very interesting for us to understand on a day-to-day basis, how do you actually manage your workflow in order to be efficient and yet be effective at the same time?
See, we start with all 220 FNO stocks scanning on a daily basis. Okay. Now, scanning does not mean that we have few scanners installed in our systems. For me, scanners are these. Human eyes are the best scanners possible. Okay, because I may not want to abstract anyone who makes scanners or who sells scanners, but I think that nothing can beat human eyes right now. That's what my belief is. The amount of risk reward you can generate scanning humanly rather than running up a scanner or running up a indicator that okay, this is crossing over this, that is crossing over that, etc., etc., the odds are very less in that you will get a trade consistently and with a better risk reward ratio. So we start our day. Instead, I'll talk on the reverse. After the market closes, I have a homework to do of say around close to around 2 hours, out of which the first hour goes in scanning all the FNO stocks listed. Though we do not trade all FNO stocks, but still I make a practice to view all the FNO stocks every day, because what how would you know that if something is cooking up very interesting, if a very interesting pattern or a very interesting trend is emerging into a new stock? You will have to get it included in your list of tradable stocks, and you will have to get few stocks excluded out of your list of tradable stocks. Now this is not a very fixed list. This can be 50 45, this can be 60 65. Roughly it's 50 60 stocks, out of which we try to pick up trades. Now, not that I have 50 60 stocks positions open all the time. I will have open positions only on 2 3 4 stocks at the max in case of leverage positions. In case of non-leverage positions, I will have at the max 7 8 positions open in terms of cash trading. But I will see all 200 stocks on a daily basis. I will see all 10 12 indices, sectoral indices on a daily basis. I will analyze the Nifty as well as Bank Nifty chart right before the market opens the next day, not on the previous day. I do stock analysis on the previous night or previous evening after the market closes, but I do index analysis only on the same morning. Why? There is a reason behind it, because Indian market opening is kind of influenced by how Dow Jones has closed overnight, how the Singapore and Asian markets, Japanese market have opened in the same morning. So there's no point in me sitting and analyzing it on the previous night that, okay, this may be my entry point in Nifty and Bank Nifty. It is not going to open there. So assuming that the market is going to open 0 0 flat is just not the case. Like, it doesn't open. It will open few points here and there. always, and it will be majorly influenced by how the Asian markets have opened, how the US market has closed overnight.
So
So yeah.
from an execution perspective, are all your entries and exit manually done at the point in time when you decide to enter or exit, or do you actually enter some of your like stop loss or profit taking into the system itself, and they will just automatically execute for you? Because otherwise, I really can't see how you're gonna be able to take a break and go for a holiday if you have to do all of this manually. So how do you go about managing all this?
See, when I go for a holiday, I make sure that all my positions are squared off. Okay, and only then I go for a holiday, because I don't want that pressure of the market to be along with me. Yeah, it's
Even the position trading itself.
yeah, cash trading is fine, like cash position. Leverage trading, I do not carry any leverage trades when I am on a holiday. It's never the case. And also you have to plan your holidays. Say, for example, if it's a 5-day holiday, you plan it with an extended weekend or something, so that you lose out only one day here and there.
I
Yeah.
see.
Also,
Mm.
coming back to the stop loss, say for example, 480 was my stop loss, right? So I will not enter 480 in my system. That's how I trade. I am a person who will try to observe that if the stock is rejecting 480 or it is sustaining below that. So I will enter my stop loss way much below, say 2-3% below it, in case there is some bad news on a stock on the media, or it is put up on the exchange of some developments by the company which is not very well perceived by the market. So the stock may go tanking when maybe I have just gone for a tea break, or say for a washroom break. In 2 minutes, the stock would go crashing down. Okay. For that, to save yourself from that, I put up say around 460 or 450. I'll put up my stop loss, but that's not my actual stop loss. My actual stop loss is 480. Even if it remains below 480 for some time, I'll exit my position. That is just it's put up just in case there is
Worst
some
case
bad news,
scenario,
and
right?
was
Worst
worst
case
case scenario.
scenario.
But yeah, and it's put up if there is some negative news, like it's very much influenced here, not here, globally as well. You had seen Netflix down 15% that day, right? So globally, everywhere, stocks are driven by news flow as well. So to save yourself from such a news flow, when you are out on a 2-minute break as well, now it's a you are humans, right? You will take 2-3 minutes break every 1-2 hours here and there. So in that case, if something comes up, it should not take me 20% away. It should not take me 30% away. Now, this generally doesn't happen every day. This happens once in, say, 3-4 months, that due to a news flow, something wrong has happened. Okay. But then why to take risk? What if your good quality stock, or your stable stock, your non-volatile stock also has some bad news and goes for a toss? There's no guarantee of anything here. So
I
that is
see.
why we put up a stop loss which is way more lower in the system based, but our actual stop loss is not that. Also,
Okay.
there is no buy above strategy for me. I'll not put a trade, say buy above 500. No, I have to see manually myself that, okay, it's sustaining above 500. I'll go and plug in my order. There is no buy above trade ever entered.
I see. I see. And so, do you at any point in time in your trading career start to think about maybe my strategy is not working out anymore? And how do you actually go about reviewing your strategy, your workflow, and make improvements on it? Or is it something that you just keep on doing the same thing all the way?
I try to do the same thing all the way, but then you have to change your strategy depending upon the market scenario. Like 2017, the whole year was a very good one-way year for Indian stocks, for mid caps as well as large caps. But 2018 has not been very good. So the strategy of riding your winners, revising your targets when the target get hits, or re-entering at the higher level of for a new fresh breakout, is not working in 2018. 2017, generally we used to hold stocks for more than 1 week, 2 week. Right now we are not holding it for more than 3-4 days. 3 days is minimum, or else we don't enter. Yeah, obviously you have a view of stock entering, giving you 5% move in the next 3-4 days. If it gives you tomorrow, obviously you have to exit. Yeah, my view is that I will not exit in before 3-4 days, but if it is giving you the return, you have to exit, right? So your sell order is always put up on the system that, okay, my target order is put up, but the buy above order is never put up.
I see. I see. All right. So that was really a very fantastic session. I think the summit participant managed to learn about both intraday trading as well as position trading. So if there's any three key lessons that you can actually impart to especially those independent retail traders, what would be the three key things that you will want to drill into their mind and make sure that they remember when they are doing trading?
Okay. First and foremost, the one which I started with, never, never, ever buy 52-week lows, and always, always, always buy 52-week highs, because trust the market. There is a reason behind a stock being at 52-week high or lifetime high, and it will keep going because each and every person entering at 52-week high knows that the stock is already at 52-week high and still wants to enter. So you will get a phenomenal momentum even at the market. If you go and analyze Dow Jones above 18,000, look at the momentum what it captured. Old high to 9100 in a matter of 1 year. So my view is always sell 52-week close. That's the first thing I would want to tell any participant. Yeah. Second thing about position sizing, will it be the color of money. Okay, the color of person, same person. You have different amount of money. You might have different amount of money. I might have different amount of money. If you are capable of trading 100 lots and I am capable of trading 10, I need not try to go and copy you and try 100 lots, because you may be able to take a stop loss on that 100 lots. My capacity is of 10 lots and I'm trading 100. I may not be able to take or bear that stop loss if it happens on 100 lots trade. Also, in the same person from time to time. In college, I told you I used to trade for 10, 20,000 capital here and there. Okay. Now, sometimes your 1-2 day exchange charges are more than 10, 20,000. The trading charges are more than that. So in the same person from time to time, you have to analyze what time frame of your life you are in. Are you in college? Are you a 65-year-old? Can you take risk? Can you not take risk? Are you matured enough? Are you experienced enough? Have you paid the learning fees to the market, not to any course? Have you paid your learning fees to the market or no? You have to analyze those things and then keep moving forward. Last and the foremost thing that's a trick for all retail investors is, across the globe, all technical analysts, what do they need? All chartists, what I am expecting that a majority of the participants in the summit will be from the technical background itself. So what do we need in technical analysis? We need what's the price today and what was the price previous before today, what was the trend before today, to analyze or to try to forecast what will be the future move. What if there is something which does not give you a chart? What will it be? Like what is the segment or what is the stock idea which does not have a chart? It's the new issue market, right? It's the IPO market. IPO market does not have stock history. That is why a lot of technical analysts are afraid of trading a stock which is just listed. They will wait for few days to few weeks to few months before taking a trade, that okay, this might move this way. Okay, now this is a trick which we give in our workshops as well to a lot of retail investors, and they are very much interested in it, is that you make an Excel sheet and you note down the high, like the greed. What we call high and low is greed and fear. You note down the greed of the listing day of the stock. The day the stock gets listed, you note down the highest point of that stock in your Excel sheet or a notepad, whatever. and then you wait for that stock to take out that high. May it be in few days, may it be in few weeks, may it be in few months. The moment it takes out its listing day high, you will get a return of 12 to 15% in a matter of 12 to 15 trading days. That's what we have been observing. And this is applicable across all the markets globally, across all the segments globally, but only on new issues.
Fun.
Or yeah, or there will also be a segment where if you know there will be hive offs in a company. A parent company is listing a separate segment of its on its own and trying to list it. This is applicable there as well. You will get a return of 12 to 15% in a matter of 12 to 15 trading days. You already know the stop loss where we bet our stop losses on. Okay, you bet on the last bear of the day. So yeah.
Fantastic. I think maybe after this session, I'll go and start looking at all the new issues to see whether I can potentially apply this as well. Okay, so lastly, if any of the summit participants would like to reach out to you or to get to know more about you, when can they go to learn more about you and the things that you do?
Okay, I update my blog, which is theprofitableIndian.in, but it's not very regularly updated. But yeah, we have a newsletter which is circulated on every morning. And right now it's on the free run. Later it will get paid. Say till October or November, it is free as of now. So they can register there and they can receive the newsletter in their inbox every morning. That will have our index view for the day, like buy above levels, sell below levels, a short market commentary, also a positional view that what do we expect in the near term in the market.
Fantastic. Thank you so much for your time, Aakash, today. It has been a really wonderful sharing that you have, and I hope and I believe that the summit participants will get a lot of value from your sharing. So I wish you all the best in whatever endeavor that you are focusing on, and hopefully you will have a chance to have a chat again in the coming days, and I wish you all the best. Thank you so much for attending today's online trading summit, Aakash.
Thank you so much, Philip. Thanks, sir.